Welcome to Capital Thinking, Energy Insights for Today's Market. This virtual thought leadership webinar series explores the challenges and opportunities affecting the energy industry. In this 2024 year-end webinar in the oil and gas market, a panel of experts from the Stevens Energy Investment Banking Group will share their findings on what has unfolded throughout 2024 and what is on the horizon for next year. We have Keith Behrens, Managing Director and Group Head of Energy Investment Banking, Brad Nelson, Managing Director and Head of Acquisitions and Divestitures, Paul Moorman, a Managing Director in the Energy Group, and I'm Deon Daugherty, Editor-in-Chief of Hart Energy's Oil and Gas Investor Magazine. Keith, can you begin by sharing some of the history of the Stevens Energy Group?
Yeah, thanks, Deon. I'm glad to do it. So Stevens has been a principal investor in the energy space since the late 40s, and our energy investment banking practice began in 2009. We cover the exploration, production, midstream, and oil field services spaces. Our group now consists of 18 professionals. Since we formed our group in 2009, we've closed 226 transactions. That's 66 billion in transaction volume. Over the last 5 years, we've closed 64 deals, 18.6 billion in transaction volume. The types of deals we're working on are M&A, advisory transactions, fairness opinions, and public and private debt and equity offerings. And then kind of one area we've been focused on recently is in the family office area. We have a dedicated group here at Stevens that covers family offices. They cover 350 plus family offices, very large family offices, and a number of those like investing in the energy space. And so we've been spending a lot of time with that group and those types of transactions. So that's a little bit about our group.
Thank you. And Brad, what types of deals has Stevens Energy worked on this year? Can you give us an overview of the team's activity?
Sure. Thanks, Deon. Absolutely. So kind of echoing what Keith just said a minute ago, it's been really the last 3 or 4 years have been active for us, and 24 has also been active. And of course, we've all had the election that, we're watching that activity kind of, running up, into November, and people were obviously paying very much attention to that. What I would say, though, in light of that, it really did not dampen our activity much at all. Certainly some noise and certainly in the background, but the overall activity was actually pretty robust throughout the year. In terms of the, sectors that we cover, Keith really covered it, so I'm echoing that. We, are probably by background, probably more heavily weighted towards upstream, which includes, working interest transactions, also includes, minerals and royalties, where we have been active for the last decade and continue to be active in that particular niche. And then we're also active in midstream and OFS, which is, more probably in Paul Moorman's background here. But we've been active across all, 3 or 4 of those niches. Like I said, probably a little bit more weighting towards upstream and minerals. In terms of, types of deals, we've got a very active and growing A&D and M&A platform. I would say over the last, 3 to 4 years, we've closed probably 7 to 8, 7 to 10, A&D, sell side transactions over the last, 2 to 3 years. And of course, that has, theme has stayed the same this year. And we actually expect to close, probably a couple more transactions on the A&D side between now and the end of the year. I would also say that we've been, active in capital raising. Keith touched on that a little bit. We've been active, raising capital from, family offices into some of our transactions, and we see that trend continuing, through the end of the year and into early next year. And then we've, also been active on the credit side as well. Have a couple activities and transactions that we're in the middle of. Cannot say a whole lot about them at this point in time, but that is robust. Of course, we've seen interest rates come off a little bit, which is certainly helpful from that standpoint. So it's been a nice mix of deal type across all of our verticals, and like I said, we see that going into 25 as well.
Great, thanks, Brad. And Paul, can you take us through the recurring themes that have emerged this year in each of Stevens' energy product lines?
Sure, Deon. Thanks for the question. Look, I would say M&A has probably driven, most of our volumes across all three sectors, whether it be upstream, OFS, or midstream this year. And, look, we were particularly busy on the upstream side during the first 6 months, but that's continued through the bulk of the year. And look, I think we all feel pretty good about, 2025 as well. In terms of themes, that we've seen across those three sectors, look, they can differ a little bit depending on which sector, but I think universally we've seen consistent themes across all three. I think the biggest one is probably, buyers looking for strategic assets that are positioned to produce strong cash flow, yields, and growth potential. At least from my seat anyway, strategics have been much more active this year than they have previously. And we've also seen an uptick in activity from financial buyers as well, particularly from the family office side, as Brad mentioned. Buyers are interested in the energy sector due to attractive valuations and what I'd argue a normalization of ESG focus, i.e., industry isn't going away. Things appear to be a bit more rational than they were, coming out of COVID. And that continues to drive, sort of activity and interest. I think there's a desire for increased size and scope, as this has been a major driver of activity this year, particularly the OFS and midstream side, as they're ultimately trying to keep up with the consolidation and the demands that what's going on the upstream side, will continue to produce on the sector overall. I think transactions need to be cash flow accretive and provide solid long-term returns. That's a recurring theme. I think people are always looking for, innovative technologies or product lines, and that's driven valuation in certain cases. I do think there's been a little bit of dampening activity, just as, at least particularly on the service side. Results were softer than expected in 2024. And I do think that did impact, look, that definitely impacted some of the things we worked on. And I imagine that's sort of a universal comment if you think about the industry overall. I think, look, from where we sit, we believe M&A, some of the M&A activity that we've seen this year will drive DCM or equity capital markets and debt capital markets activity next year as people look to tap into, the equity capital markets, either to refinance debt that they took on as part of that M&A or look to go public. And then on the debt side, I think a lot of those folks will need to refi or get bigger credit facilities to run sort of the combined, larger businesses.
Okay, thanks very much, Paul. So Keith, can you tell us what was a particularly notable deal that Stevens Energy completed in 2024? What was the client trying to accomplish? And then how did Stevens facilitate that goal?
Yeah, thanks for the question, Dan. I think what I'd say, rather than mention a specific deal, just say that we have several clients that are looking to replace institutional investors that have lost their appetite for oil and gas, with other types of capital. And this is a kind of a big focus area of ours, is just kind of finding that capital to replace these LPs that want to leave. And so I mentioned it on the first question that we have a group here at Stevens that covers family offices. We're spending a bunch of time with that group to identify those family offices, that like the oil and gas space, and just have a number of clients that are real interested in that type of capital. It's real relevant, for them, again, because even with things kind of getting a little better here, there still are a lot of LPs that do want to leave the space. And so we're trying to help our clients, find sources of capital that will replace that capital that's leaving the space. And that's a big focus of ours. And a lot of our activity is kind of work on those types of transactions.
Right. Thanks, Keith. So Brad, what is the team's view of the condition of the oil and gas industry at the end of 2024? What are its challenges, opportunities, and then what factors might influence activity next year?
Thanks, Deon. Well, look, Keith just mentioned one of the challenges. which is the lack of capital or scarcity of capital and overall capital, I think to some degree still trending away from the conventional oil and gas industry. And anybody that's been in the industry for the last 5 to 10 years, that's really nothing new. We've got kind of a new sandbox, if you will, and we kind of understand who are the capital providers that are staying true to the industry and being supportive of the industry. And so Keith is exactly right. The capital has been challenging across really all different kinds of capital. That's equity capital, institutional capital, private equity capital, and then even on the private credit side and the regulated banks. I mean, it's all been very difficult for the last 4 to 8 years plus or minus. So don't really see that trend changing a whole lot, other than, as Keith mentioned, you do have some family office capital providers coming in, which has certainly been helpful for us and our clients. One other challenge that, again, nothing new, and that is just pricing volatility. It's actually been fairly stable on the oil side of the equation for most of the year. I think we've been, high 60s to, seeing maybe 80 at times, but in that kind of, price band, if you will, people are able to plan, people are able to develop, properties and basically have, good returns, if you will, associated with that CapEx and planning. So the oil side of the equation has been fairly stable. Gas has been a different story in 24, and I think most people recognize that. I think on the gas side of the equation, we've been below $2 per M and at 2 for a lot of the year. Say in the last, call it 3 to 5 weeks, we've seen a nice uptick in natural gas. I think we are, north of 3. I think the curve, for the most part, the strip for the next 5 years is well north of 3, which kind of same thing and phenomenon as the oil side. I think if we have, 250 to 350 in that band, it does allow people to feel good about planning and feel good about, spending capital. So those are some of the challenges. On the opportunity side and kind of the outlook, I mean, we're optimistic. We have been at oil at or above 70. Now we've got gas north of 3, and we are seeing our clients, do a lot of planning. We're seeing our clients, looking at a lot of acquisitions. And again, I'll kind of reference the election. I think with that in the rearview mirror now, and I think people's take on the new administration and how that is going to affect regulatory governance and just overall kind of a friendly nature, if you will, to the industry. I think people are going into 25 very optimistic.
Thanks very much, Brad. So, Paul, can you tell us what kind of deals, what types of deals and deal structures have been the most common in the oil and gas market this year, and why are they taking precedence?
Yeah, look, I'll sort of maybe focus on M&A, because I think that's the easiest one, probably to put in a box to a degree. And to me, it's really been driven as much as anything just by what I'll call plain vanilla buyouts. That's been the preponderance of the activity this year. I think that will continue to be true next year versus JVs or minority investments or things of that nature. Look, we continue to see many deals have some level of stock as considerations as buyers look to maintain, balance sheet primarily, and or potentially share risk or keep the sellers sort of incented and rowing in the same direction and keep all interests aligned. Earnouts and seller notes or other forms of contingent payments continue to work their way into many deals as buyers look to increase the probability that they got it right, that they didn't miss anything, and they want to share some level of risk that the cash flow stream they expect to buy ultimately turns out to be true and correct, at least for some period of time. I do expect terms offered by buyers to follow similar themes next year as buyers attempt to remain prudent. As Brad mentioned, all this at least in my mind is driven by continued commodity price volatility and just some level of uncertainty on whether we're going to be at $3 gas or $1.75 gas or $90 oil or $50 oil. And so again, people ultimately want to make sure they don't get that wrong. when they're pursuing M&A, and therefore these themes continue to pop up. On the financing side, look, we have seen, it's called some creative structures sort of pop up on the upstream side of the equation, and even midstream, whether it's through the use of preferreds or other things. We are seeing some new flavors, on those particular sectors or subsectors, I should say.
All right, thanks, Paul. And Keith, kind of bouncing off of that, what has been the appetite for non-traditional financing structures like volumetric production payments or VPPs, asset-based securitizations, ABS, prepay products, and so on? And is that appetite poised to change next year?
Yeah, good question. I think, just in terms of kind of the bank lending market, it's improved. Some banks that have gone away have come back, and, with the higher interest rate environment this past year, and really bank financing being the lowest cost debt option, there's really more interest in this option amongst borrowers versus any other of the kind of non-traditional debt options. That being said, the higher interest rate environment and just generally softer commodity prices caused a slowdown in the alternative debt markets. Advances were lower. I think there'll be a pickup in activity next year, with the move in gas prices that Brad alluded to, and just falling interest rates. So I'd expect, the unitranche and ABS activity to pick up. And then, unitranche lenders are wide open for business, since they've struggled to put capital out in recent years. We've, in our deals, we've been seeing spreads tighten materially, and covenants get lighter in an attempt for those lenders to put money to work. We do have several groups interested in preferreds. That's cheaper than common, so issuers like that type of option. And then, one thing that I think we'll see these groups fund and participate in is the CV market, or the continuation vehicle market. There's a lot of older portfolio companies that really need to do something, and a continuation vehicle could be a solid option for them. And that's just essentially a recap where LPs are taken out with new institutional or family office capital, and economics are reset. And so that could be a good option. There could be a lot of capital activity around that type of transaction structure.
Great, thank you, Keith. So Brad, are many energy companies aiming to grow assets and production, or instead are they planning to hold production flat in 2025? Of those that are planning to stay flat, are they focused on distributing excess cash flow to equity investors, or are they still trying to pay down debt?
So, Deon, what I would say to that question, and there's a lot in that question. Look, I think that coming out of COVID, into 21 and where we are today, I think that the industry has just been very focused on financial discipline. I think that, if you look back through, call it 16 through 20, commodity prices were lower. The returns generated by the industry weren't great at that point in time. I don't think you had a whole lot of companies that were able to, provide, cash flow and distributions to their LPs and shareholders. And I think that has really changed a lot in the last 3 or 4 years. So, look, I think that, in our opinion, the ultimate scorecard for a lot of these, upstream companies is production. Of course, they are, concerned about what do their, reserves look like. What is the mix of, undeveloped versus developed reserves look like? And is there a continual shift from undeveloped reserves to developed reserves? But at the same time, I still think that they are probably more focused, or at least have a slightly higher priority on financial discipline. A lot of these companies are now, and have been for the last 3 or 4 years, very healthy. I think they appreciate these healthy balance sheets. So leverage is I think near an all-time low. And at the same time, they are able to distribute cash flows to their shareholders. So with the new administration coming in, even with the, regulatory environment possibly, easing a little bit, I think we're still of the opinion that financial discipline is going to win the day. And these companies are still going to be very, very focused on maintaining healthy balance sheets and providing their shareholders with yield.
Thank you, Brad. And Paul, how competitive are unconventional natural gas and oil resource companies at the end of this year, given their break-even price? And are there any developments that may bolster that competitiveness in 2025?
Look, I think ultimately, in terms of break-even price, I think they're doing their best to remain competitive. Look, sort of drilling technology continues to get better. They all continue to squeeze out efficiencies, whether it's by the service providers or how they're sourcing things or technology that they're using, to use a buzzword, AI or other things that they're using in their techniques. So, look, I think in a lot of ways, they will continue to be competitive, up into a point. And look, you're also seeing, because of that, different basins that, at least over the past several years, haven't necessarily been an area of focus, get increased sort of activity as people revisit them, just given higher prices in what I'd call the preferred basins these days, as people just say, look, I can still drive returns with sort of these new innovative techniques, and therefore I'm willing to look farther afield in things that may be not necessarily straight down the fairway, because I can get in an interesting entry point and sort of drive the ultimate returns that I need.
Okay, thank you, Paul. And Keith, how active have private equity firms been in energy this year? And to what extent do you see that maybe changing in 2025? And what role has private debt played?
Yeah, private equity activity has picked up. There's a handful of funds that have been pretty active. Trace, Natural Gas Partners, InCap, Carnelian, and Pearl, and Post Oak have all been active in backing new teams or backing teams that they've re-upped with. There's more capital available too. There's been several funds that have closed here recently. InCap, NGP, and Quantum just closed funds and raised collectively over $20 billion. So there's more capital available for next year. So I would anticipate activity picking up. I think just a couple notes too on these, kind of consistent with the theme. There's been quite a bit of turnover with the LP base and these new funds that were raised. So there's more family offices that have participated in those funds. And so that's just kind of an interesting side note. I do think one of the areas of activity will be these continuation vehicles that I've mentioned before. There will either be private equity funds that will have portfolio companies that pursue continuation vehicles. And then some of these private equity funds have dedicated new funds that kind of target source of capital for continuation vehicles. So I think there'll be quite a bit more activity in 25 versus this year, but things have picked up quite a bit.
Thank you, Keith. So Brad, to what extent have family offices, which Keith just mentioned, been active in energy? And then what types of deals are they targeting? Do you see an extensive role that family offices may play in energy companies next year as far as energy companies trying to access capital?
Sure. Thanks, Deon. Look, I would say kind of going back to COVID and beyond, and then since then, look, we have seen definitely a transition from family offices being somewhat on the sidelines of investing into energy transactions of all kinds. And we've seen that, trend grow really each of the last, 4 years. So if you look back through calendar 24 and 23, there's been a lot of families that have put capital into all kinds of energy transactions. The other thing I would say too, continuing trend is, there, in our opinion, are kind of two types of families. There are the historically energy focused families that has been one of their kind of main ways of making money over the years and decades. Those groups have been pretty active in energy for the last 4 or 5 years. And what we're starting to see more and more of are the kind of generalist family investors, families that may have invested or focused on 2 or 3 other verticals and not so much energy over the last, whatever number of decades, that now we're starting to see trends where those families are now coming in and making investments into energy. So it's been a nice mix of new entrants from the family pool of capital, coming into various transactions. In terms of what they're looking for and where they've been most active, I would say it's probably been more on the upstream and midstream transactions. And, within upstream, I'd say they've probably been a little bit more active on the mineral and royalty front. As we all know, that is a asset class that is a little bit less risky. If you're an investor in a mineral and royalty company or fund, you're not really on the hook for CapEx. So it's kind of capital light, if you will, other than the entry, kind of price point. So it's just a great asset class for family investors, and of course it provides continuous and fairly predictable yield along the way. So we've seen investors interested in that asset class and also in midstream. Kind of same thing. It's a little bit less less risky, a little bit more diversification among assets, and the cash flows are more predictable. And then lastly, I would say that the family offices are a little bit less interested in OFS. So I'd say, in balance, it's been more on the upstream and midstream side for families.
Right, thank you. And Paul, kind of going back to the M&A side of things, how challenging this year has it been for companies to finance these acquisitions in the market? And do you see that trend sort of persisting or changing next year?
Yeah, look, I think the theme that continues to come up on the call, right, is there has been somewhat of a dearth of capital in the sector if you think about what it's been historically over the past several years, and that continues today and will continue into next year. As Keith mentioned, we continue to see it get better. Banks that weren't lending are lending again. Private capital has raised a tremendous amount of money that they're looking to put to work in the space. Look, I think M&A opportunities are always an interesting way to deploy capital. And so therefore you are, seeing deals get financed. What we ultimately see is in a lot of M&A trades is there can be a gap. And so back to your question earlier of, structures and other things, it will require increased levels of, buyer rollover, for example. There may be seller notes, there may be earnouts as sellers ultimately look to get to a valuation they're happy with, and buyers, are able to finance that valuation. So, look, while debt and equity continues to be there for, financing purposes, it is more difficult than it's been historically. The bar is higher. And look, all those sources are seeing all sorts of deals. And so they're just being more picky to make sure they high grade, at the end of the day, their investment portfolio, which makes total sense. But we feel good about where we are. And, probably most importantly, that the continued trend that we see, particularly when you factor in sort of the public markets and their receptivity to follow-on offerings on the upstream side and other areas of energy.
Thank you, Paul. So Keith, what headwinds and tailwinds are energy companies likely to encounter in 2025? And how is that poised to impact deal activity next year?
Yeah, I think, I think the tailwinds are, I think Brad and Paul both alluded to it, but just, probably an easier regulatory environment, maybe a little stronger long-term international natural gas demand with, maybe new LNG permits coming back around. Possibly another tailwind is just large corporate consolidation could lead to a lot of M&A activity with the surviving firms just carving assets off from that consolidation. And that could also lead to new backings of teams who got merged. Another tailwind we talked about a little bit is just credit markets are open. I think especially the unitranche market. Equity markets are also starting to open, including the IPO market. The headwinds, I think, are just, China, possibly a little weaker demand coming from China that could hurt oil prices. Maybe with the easier regulatory environment, there could be some companies that just have less discipline and are more active in drilling, causing prices to come down. I don't think we're going to see that, but it's a risk out there that could play into things next year. And then, there's just been some volatility in the gas market. Gas prices have come up, so that's a positive. But the volatility kind of causes a little bit of a bid-ask spread and those types of transactions. I think generally, though, the tailwinds outweigh the headwinds, and I think that's just going to lead to more deal activity in 2025.
Thank you, Keith. So, Brad, how many new buyers or sellers have emerged this year? And do new entrants in the market have any different considerations than maybe established players might have?
So what I would say to that is that the private buyers, if you will, have continued to make up a pretty good portion of the buying universe. So I would say historically, a lot of our transactions and transactions that I know others have worked on, a lot of them were those transactions were bought by public companies. And I say that over the last 3 to 4 years, you're seeing just more and more of a theme and a trend for the private universe to step in and ultimately be the buyer of that company or assets. And so, in terms of just new buyers, again, kind of echoing what we've all said earlier, in the call, you're having more and more new and unique, family offices either come in and be a bigger portion of the overall equity financing a deal or part of a, syndicate coming in and financing a deal. So continue to have new family offices come in as buyers. But, overall, at this point in time, we just see the trend, continuing where private companies are being very active, on the buy side. So I'd say that's been the biggest trend going into 24, and we see that continuing in 25 as well.
Right, thank you. And Paul, are you seeing many energy firms capturing new opportunities in specific basins? Which areas are getting the more significant attention, and why is that the case?
Yeah, look, obviously the Permian still drives the preponderance of the discussion as, in terms of break-even pricing and just overall activity levels and sort of runway. It's best in class, not only in the US, but globally. We have seen renewed interest in other basins, as you mentioned. The Eagle Ford has definitely seen an uptick. There are certain areas in the Rocky Mountain basins that I think we've seen, renewed area of focus. One thing where things have slowed a bit is just the Haynesville, not because I think that one faces long-term, sort of headwinds. It's more been a function of, as Brad and Keith both mentioned, current gas prices, I would argue, primarily put in place because of some of the scares around roadblocks with LNG. But I think hopefully with the new administration, that sort of moderates or goes away entirely in the Haynesville and, sort of kicks back on. I think the main thing driving interest for buyers and investors, regardless of its, sector, is just perceived returns and cash flow yields. Some of the favor regarding more ESG targeted solutions have abated to a degree. We don't necessarily see huge premiums being paid for, electric equipment, for example. And I think that's somewhat due to either renewed uncertainty around the proposed regs or just, at the end of the day, the end customer likes a more ESG sort of environmentally friendly solution, but they're not necessarily, willing to pay a premium for it.
Got it, thank you. So Keith, what concerns or priorities have equity investors had most strongly in 2024? What are their main goals? What themes have come up in talks between energy companies and equity investors?
Yeah, I think there's kind of several points that are important to investors, and they're pretty obvious. I mean, they like financial discipline, limited amount of leverage ahead of their equity investments. Cash flow distributions are very important to them generally. And then on the upstream side, they like scale to grow the business with, low risk development potential, kind of all pretty obvious things, but those are the things they're looking for. And along those lines, they like management with, skin in the game and just proper alignment. The concerns, I think, are, kind of more macro, but weak Chinese demand that could impact oil prices. I don't think it's too much of a concern yet, but this looser regulatory environment does probably come into play a little bit. The companies have generally been very disciplined, but there is a history where there's been too much drilling and it's caused softness in commodity prices. So it's not, I think we'll see companies, continue to be disciplined, but it is a different environment where, it'll be a little looser. So that maybe comes into play a little bit, but that's kind of some of the themes we're hearing about from investors.
Thank you. And Brad, what impact has the shifting interest rate environment had on deals? What might happen to deal activity if rate cuts continue, if they continue to occur at such a regular pace, or what if rate cuts are less frequent? What might be the impact?
Well, stating the obvious, if interest rates do continue to come down, it reduces everyone's cost of capital. Credit will tend to loosen and possibly be a bigger portion of acquisition consideration. So, I'd say in general you do see M&A activity pick up a little bit when credit loosens. And so if that continues, then I expect M&A activity to pick up. The A&D activity for 24 has been fairly robust. We saw a fair amount of corporate M&A activity in Q1 and in Q2 of this year, and then it started to fall off in Q3 and has been a little bit slower in Q4. But I would expect that would probably pick back up if interest rates and overall cost of capital come down. So, but that being said, I think the industry is also pretty good at just understanding kind of, okay, here's the cost of capital now, and how do we kind of adjust our thoughts as it relates to valuation, what assets are, provide attractive returns and what don't. And so I don't really see a dramatic impact one way or another, whether interest rates move, a lot. I think that the industry kind of sees, okay, here's what the new rates are, here's the current view, and how do we factor that into our analytics? So, I think as long as we have a pretty stable, overlying commodity price and revenue driver, and people kind of understand and are able to plan and spend capital, I think that is probably has a bigger impact on M&A activity compared to interest rates.
Oh, thank you, Brad. So then, Paul, how relevant are the current OPEC production decisions and U.S. allowances for domestic production to the oil and gas market in the view of Stephen's clients?
Yeah, look, I think overall, OPEC still gets a lot of, airtime, and what they're thinking and how they may react is something people pay attention to, which they should pay attention to. Look, all the forecasts you see out there, the U.S., at least at the current time, and for, sort of current forecasts out there, continues to take more and more market share on a global stage, particularly from a crude production perspective. And look, I think that will remain sort of true. Look, I've been pleasantly surprised over the years with OPEC being rational and really looking to maintain sort of more commodity price rather than market share at the end of the day. And look, they're still the biggest share of the production market, globally. So, and I don't think that's going to change anytime soon. But do people pay attention to it? Absolutely. Should they pay attention to it? Absolutely. But I do think, they continue to be rational, particularly when you factor in, some of the domestic sort of monetary struggles with, you're seeing in Saudi Arabia and other places in the Middle East. I think they need to be prudent because at the end of the day, it's not about production, it's about cash flow, just like investors globally. And so they, have to sort of watch their P's and Q's.
Right. Thank you, Paul. And Keith, what about the ongoing conflict in Russia, Ukraine, and in the Middle East? To what extent are deal makers perhaps affected by risk to energy production and distribution in those areas?
I think the impact's really more on the macro price environment, and those conflicts just cause volatility and uncertainty. So, I think that's how the investors kind of worry about those conflicts and just how they impact the price environment. So any resolution And either or both of those conflicts, I think just makes for more certainty in the macro price environment and would improve the investment environment even more than what we've talked about or what we're expecting in 25.
Thank you. This has been quite an enlightening conversation. Thank you again, all of you, for sharing your thoughts. And this concludes the 2024 year-end webinar in the oil and gas market, a Stephens Investment Banking webinar panel. Be sure to view the rest of the virtual Thought Leadership series. Have a great day.